Okay, I think we are live. So, welcome back everyone to Fat Free Economics. My channel is about taking out the spin and the clickbait headlines from the news and helping you to understand what's really going on with the economy, right? And so today we're going to have a little bit of fun. This is a bit amusing news, but I think it also is a fun way to get into some lessons about how companies are evaluated. When companies are looking to go into an IPO situation, or they're looking for venture capital, or an angel investor money. What is the process whereby they are judged, evaluated, and what determines whether they get the money or not, right? So I mentioned before that I have an economics degree. I am an economist, and I may have already mentioned that I also have an MBA with a specializing focus. I can't talk today on entrepreneurship. So for a time, I was even president of the Student Entrepreneurship Association in my business school. So this is something that we discussed and analyzed, and we spend a lot of time evaluating companies and so on. So I felt like this would be a fun topic to talk about company valuations, and we're not going to get into all the titillating details about OnlyFans. There's not going to be any video clips or naughty images, but still, this is a fascinating business case because OnlyFans has some serious challenges in terms of acquiring investment capital. So, you know, um, we're going to talk about that. And the process that I'm going to be using is to say, hey, if I were a venture capitalist, how would I go about actually doing an objective valuation of OnlyFans? And let's see where the process takes us. Is it a yes? Is it a no? Are they worth $1 billion? Right? But before getting into that, let me first say that I stream every Wednesday night and Sunday afternoons Pacific Standard Time. But there's times when the news is, there's a lot of news out there. So I feel like sometimes I need to stream extra. So just to let you know, tomorrow um, I'm going to give an update on the labor market shortage situation. There's been some new data that's come out, and I think it's starting to clarify the situation. So we'll talk about that tomorrow. And then on Friday, right? Facebook has also been in the news, right? OnlyFans doesn't get all the attention. Facebook has also been in the news because they're being sued by the FTC, the Department of Justice, because they are the contention is that they are a monopoly, right? And they need certain legal safeguards. So we are going to look at that situation not from a legal point perspective because I'm not a lawyer, but economists have specific tools to assess whether a particular business like Facebook is a monopoly or it is not a monopoly. And I think you might be surprised by the conclusions I reach. It's not what you're likely to expect. So, anyways, with that said, let me jump into the whole topic of OnlyFans and say, are they worth $1 billion valuation? So let's start with just a brief overview of what's happening in their search for investment capital. So let me share an article with you, and I'm going to bring that on screen. Okay, so okay, so let me take that away. Okay, so the first topic that we're going to discuss is basically, is OnlyFans worth $1 billion, right? And so if you look at this article, OnlyFans looks to pivot away from pornography, seeking 1 billion USD valuation, right? And so, I mean, what happened was, uh, you know, um, so what happened was during the lockdown, I guess a lot of people have a lot of free time on their hands. So the number of subscribers, customers, whatever you call them, has exploded, and their income uh, increased very substantially. I think they're talking about revenues of $400 million per year, and the total amount of money exchanging hands on the website, I think, was about $2 billion. We'll look at the actual figures, but that's a lot of money, right? And I think it's only natural that they're starting to, I mean, the management of OnlyFans starting to think about going mainstream in a sense, right? There's certainly a substantial financial entity already, right? But now they're thinking, uh, can we take advantage of the situation of the lockdown and get access to venture capital funds, right? But as you can see, they have certain challenges, and the article right here makes note of that. The not safe for work image tied to OnlyFans has made it difficult to acquire funding. Aside from making it easier to lock down advertisers, OnlyFans could look to move away from its adult content image and pivot toward mainstream media to reach its $1 billion US goal. And now I have highlighted, and let me just show that code here. I have highlighted this particular paragraph because it encapsulates so much of what's happening with the OnlyFans situation, right? Because of their quote unquote adult content, they're having two major challenges. One is, you know, they're likely having difficulty attracting mainstream advertisers, right? If you are a social media company or a video platform, obviously there's a lot of dollars to be made in advertising, but what type of companies are likely to advertise in OnlyFans? There's a limited number. I don't think Nike is jumping up and down looking to advertise with them. I don't know, cosmetic companies maybe. Lingerie. I don't think even Victoria's Secret is interested in advertising on this platform. So the challenges of attracting advertising dollars is certainly significant. And then there's the whole notion of them trying to attract investment dollars, like we said, right? What would induce venture capitalists to invest money in this platform? Now, I think with regards to venture capitalists, the article is making a bit too much deal about the not safe for work image because they are venture capital firms. I'm sure they have their concerns about their own reputation, but they're more likely to take a hard-nosed business look at the business model and say, is the valuation justified exactly the way that we're trying to look at this situation at OnlyFans and seeing, is it worth $1 billion, right? And I'm not trying to prejudge here. Don't take anything from my tone of voice, because this is a serious business venture. They are making a lot of money, right? And I don't mean to make light of that, right? And so, moving on to an overview of the about their numbers. I just wanted to mention that some of the revenue numbers that's being reported and the pre-tax profit. So revenues in 2020, $390 million. That's a lot, and about $2 billion going from the fans to content creators. That's a lot of money, right? And OnlyFans takes, I think, about 20% cut, and their pre-tax profit of $74 million between November 2019 and 2020 was reported by the Financial Times. So that's a reputable publication. So likely those numbers are somewhat credible. I mean, OnlyFans is not a publicly traded company, so they're not under the type of scrutiny that you might expect from IBM. But I think these numbers are probably pretty close to the reality, right? And so, what's going on with this situation, right? I mean, what is it about OnlyFans that um, really attracts all this attention and um, all this excitement, if I might use that word? No pun intended. Okay. Um, so, let's look at some of the numbers being reported by Insider. OnlyFans has boomed during lockdown. Users spent, like I said, yeah, 2.4 billion on the adult entertainment industry site in 2020, and 120 million people are using it now. So clearly, you know, um, this is no joke. 120 million people are participating, as fans and contributing their dollars into the platform. And I mean, 2.4 billion is certainly a lot of money. And if that's the kind of money that's being traded hands, that are trading hands, does it seem like maybe $1 billion valuation isn't really out of the question, right? So this is one of the celebrities now. I'm sure you're aware of her, Cardi B. Um, and she's raising the visibility of this platform and, in a certain sense, making it more credible, right? Now, the thing that, you know, sorry, I'm scrolling down to the part where I had, um, the highlighting. Okay, so this is more reporting because I wanted to see the numbers reported by multiple outlets so that I could say that they're pretty credible. So, yeah, 74 million um, in pre-tax profits, and the CEO at this time was saying he expected pre-tax profits to top 407 million in the next financial year. So he's probably talking about 2021. That's why. So if they're really making a pre-tax profit of $417 million, then a valuation of $1 billion doesn't seem too out of bounds. But is it really? Okay, so let's start taking a look at this from a more of an economist point of view and more of a venture capitalist point of view. Now, this is an answer that I would give to the layman, to the general public. We're not going to get into all the technical details of finance and valuation, uh, you know, um, a methodology, right? I want to just more give a sense in the public about the thinking that goes into evaluating a company of this sort, especially for someone for a company that is rather unique, right? It's a social media company, which is still relatively new um, in terms of having evaluation methods applied to it, and then also there is the further challenge of adult-oriented content, right? So let's start thinking about what it would mean to invest money into this company, right? And so when you are a venture capitalist, right, um, one of the first things that you want to consider is something called a sustainable competitive advantage. And so let me show that banner here, okay? And let's take a quick look at what that really means, okay? Now, the reason why venture capitalists and angel investors talk about a sustainable competitive advantage is that for the obvious reason, right? You are competing in this market, right? And before they put their money into your business, they need to know, number one, what advantage do you have over your competitors? And number two, the key thing is that advantage sustainable, right? The sustainability is what really matters. Because you know that in economics, for example, an advantage in profit margin or price is likely temporary, because other competitors are going to come into the market. They're going to undercut you on the price, take away some of your market share, and therefore you have no choice but to cut your own prices to remain competitive. And suddenly you're just like every other competitor. You have no advantage in the marketplace. And so, as a venture capitalist, you want to know, is this advantage sustainable? An example of that would be intellectual property, right? For example, right now, Disney is having great success with the Marvel universe, the Marvel Cinematic Universe and the movies and TV shows that are coming out. Well, it's hard to compete against that in a certain sense, because you certainly can't copy it, because that would be a copyright violation, right? Obviously, the other major studios have their own intellectual property, right? But you certainly can't compete on Marvel property because that's owned by Disney, right? So therefore, that ownership implies a sustained advantage, an enduring advantage that will pay dividends for years to come, right? And so the first thing that really kind of catches your eye, I'm going to go back to this thing right here, this quote, which is the fact that, there are other video platforms out there, some more popular, some certainly bigger than OnlyFans. For example, YouTube, where a lot of video is being distributed. But of course, when we talk about the advantage of OnlyFans, the thing that they really have is that they allow so-called adult content, right? I think there's a little bit of other stuff that's happening, and some of the celebrities that are coming on are able to attract their own following, right? And it's like, for example, Cardi B is giving videos about, backstage view about music videos and that stuff, and so on. But for the vast majority of the creators out there, they are basically undressing, if you will, to attract fans, and that's the advantage of OnlyFans, right? And of course, it has the resulting disadvantages, right? Uh, of the fact that um, uh, well, I mean, advertisers are not eager to, put themselves on this platform, and of course, the valuation question is now being faced by the company. So, the first question to ask then is their advantage sustainable, right? What is to prevent another video distribution company or another social media company from saying, hey, you know what? We're going to offer creators the same opportunities that they are, right? I don't know. There might be legal constraints based on the location and the headquarters of the company, but other than that, I mean, certainly, excuse me, OnlyFans has what you might consider first mover advantage, right? In the sense that this particular revenue model, right, a paywall for paid content is is their thing, right? But is it really? Because how is this really different from any of those so-called pornography sites, right? Where there's also free content, there's also a paid content behind the firewall, or so I've heard. I would know, of course. And so when you think about the concept of competitive advantage, to my assessment, it looks a little bit shaky, right? Can another social media platform provide similar services and be competitive? I'm gonna say probably yes, right? There's no technical limitations, right? There's Well, I really can't think of any reason why a new startup or a current media company couldn't take on this kind of content, and have that same kind of revenue sharing model, right? And then also, uh, this revenue model isn't completely new because the porn sites have been doing this kind of thing for years now, right? In fact, a lot of the porn sites are innovators with regards to um, content distribution and revenue sharing and revenue collection. So you know um, so in terms of what you might call a long-term sustainable competitive advantage, I don't see a lot there. I really don't, right? Now, if you think that there is, let me know down in the comments. Maybe I've missed something about OnlyFans because I honestly I don't subscribe to the site, right? So I don't know what it's like to actually access the site. Maybe there's something about the experience that has a stickiness, right? That makes you keep coming back for more. But it's important to note that the content is not created by the platform; it's created by content creators, right? And so you have to ask yourself, if another platform offers a better deal, right, in terms of revenue sharing, what's to keep that content creator from moving over to the new site? I don't see a whole lot of reasons, right? So I think in the first perspective of competitive advantage, for the purpose of a company valuation, I think they're looking pretty weak, right? But that is not the only uh, way to evaluate the company, because obviously it's growing, it's successful, and so we can't ignore that. So another way to look at this company and perform a valuation assessment is something that we call the discounted cash flow model, right? So let's take a quick look at that. I promise we're not going. It's very technical in its actual implementation, but I promise we're not going to get into the technical detail. But I want you to understand the general thinking and the general principle of how that the discounted cash flow works, right? So let's take a quick look at that. Um, so here it is. First, we're going to look at the definition, and then we'll talk about what that actually means in common sense terms, right? Discounted cash flow is a valuation method used to estimate the value of an investment based on its expected future cash flows. Well, like like a typical explanation in a dictionary, it almost sounds circular. It sounds circular, saying it's a discount. Valuation is based on the discount. Uh, then what is the discount, right? It's almost like it's pushing back the definition. And what is all this supposed to mean? Well, there is a economic concept which is called expected return or discounted return. So let me say I were to offer you a deal, right? You have a choice between me giving you $1 today, right now, versus giving you $5 a year from now. Now think about that. What would you prefer? Well, it would probably depend on what you thought about my prospects of living until 5 years from now, and how committed I am. How could you enforce that agreement, right? So there's some uncertainty there because of something might happen. I might be run over by a car, struck by lightning, get married or run off to the Bahamas or something. Can you enforce the contract? So because of that uncertainty and your personal assessment of how high that risk goes, you might just say, no, you know what? Just give me the $1 now. I'll take that $1 and I'll invest in the stock market and get an average 8% return. And that's good enough for me, right? So this is the basic concept of a discounted cash flow. Now, how does that apply to this company? Well, it's rather obvious, right? It's like it's as we were saying. Let me show. Okay, oh, sorry, I needed to change the banner down below. So now we're talking about the discounted cash flow valuation method, and so in this quote, the CEO Tim Stokely is really offering you the same deal in a sense that I just did, okay? Which is he's saying he expects a pre-tax profit of $417 million sometime in the future, in the next financial year, if you give me the money now, right? So that's the deal, right? You invest your money in my company, give me a valuation of $1 billion. You collectively as investors, whoever comes into the deal, the first round of funding, venture capitalists, angel investors, or whatnot, collectively you evaluate this company at $1 billion, and in the next fiscal year, I expect to earn $470 million, which will be distributed either as dividends or retained as equity in the company. So do you see how the discounted cash flow really kind of mimics that situation, right? Cash now versus the value of cash sometime in the future. And again, the actual equation for calculating this is rather complex, but there's no need to get into it. I mean, as long as you understand the economic concept, right? And I'm sure right now you're probably thinking about some friend who still owes you $100 for losing a bet on a basketball game or whatnot, and you haven't been paid back yet. So I think you get the point here, right? The future has risk, right? And that level of risk is the discount that you apply to the promised future cash flow, okay? And so if we were to run through this equation, does that mean that we're going to have a definite finite number and saying, okay, it's not $1 billion, but it's $800 million or $600 million? Well, not really. That really depends on your own personal assessment of their risk, right? And the truth is, different venture capitalist firms will have different assessments of the level of risk and apply a different discount. So that's why basically these companies go around, shopping their business model and their financials and say, we need to find somebody who agrees with our interpretation of that discount rate, and therefore will receive the $1 billion valuation that we think is justified, right? So that's how the discounted cash flow works, right? So you also see the connection between the discount versus what we talked about in terms of a sustainable competitive advantage, right? If you, as a venture capital firm, believe that this particular company has a competitive advantage that is sustainable, then the discount factor is actually very low, right? Because the risk is low, if you see what I mean, right? And so, that's why, you have these layers of different valuations. You're looking at the company through different ways because they are, in a sense, interrelated, right? These different looks give you an overall assessment, right? Your view about the durability of their market competitive advantage will have an impact on the discount rate, right? And the lower the discount, the greater the valuation. And so basically what the CEO is saying, I'm very confident in my expectations of future revenue, specifically the next financial year, and he's expecting over $400 million of revenue, right? He's probably right about that, right? It's a very popular platform. But is this still worth $1 billion? Well, you could further elaborate on your analysis by use of what's called a SWOT analysis. So let's take a look at that third valuation method. Okay. And I'm going to bring that to you. So the way to think about this is to have, or to say, you know what, I've already had a look at the sustainable competitive advantage question, but I want a broader perspective of, of how this company is doing with regards to the competition, with regards to the market. And so you might perform what's called a SWOT analysis. Now, the truth is, modern venture capitalist firms have more sophisticated ways of analyzing companies, but the basic conceptual framework of how they approach that kind of assessment is very similar to what you're seeing here. SWOT stands for, it's an acronym, if you haven't guessed that already, for strengths, weaknesses, opportunities, and threats, right? And so you can see how this is a further elaboration about the whole question of sustainable competitive advantage, right? You're thinking about, in this case, OnlyFans. What are the strengths that they have? Well, they're already very popular, right? Having an established brand name or an established image in the market where 120 million people are accessing your platform is an enormous strength. We can't ignore that, right? And with regards to, for example, the weaknesses, right? We're basically making an assessment that, the one thing that they have over the competitors like YouTube and other video platforms is that they allow for adult-oriented content, but how sustainable is that? It's you might regard that as a weakness because it really doesn't take that much for another competitor platform to say we're going to do the same thing. We're going to borrow this revenue model, and steal away some of your customers. So on that note, let's take a quick look at some of the statistics for the OnlyFans, right? And this is kind of breaking down some of the money that is being made. And the first thing that I want to talk about is that OnlyFans takes a 20% cut on its user transactions, right? And when you talk about particularly one about the weaknesses, we can easily imagine where another platform, a startup, Lean and Mean, are saying, well, we're only going to take 10%, right? Now, 10% for a online creator is probably a substantial difference, especially if they're making a lot of money, right? And we're talking about the celebrities who are attracting huge followings, making millions of dollars. So even a difference of 10% is probably a lot of money to them, right? So that is very, very compelling, right? And what's to keep content creators on OnlyFans if someone else offers a better deal, And here's the other thing to consider in terms of weaknesses is that looking at the statistics, okay. So OnlyFans business model is straightforward. They provide a platform for paywall content. We didn't mention that, and so they take a very healthy 20% of it. That's a lot for an online transaction, But here's the thing that also we need to keep in mind: the top 1% of accounts make 33% of the money. 1% makes 32%, and in fact, if you look down here at the statistics, the top 10% of accounts make 73% of all the money. Okay. Now, that has some serious implications with regards to this analysis, especially with regards to the weakness that we might see, which is if there are so few accounts that are making so many of the money, what's to prevent them from going on to another platform that charges only 20% for online transactions? Not a whole lot, especially when you consider the fact that the people who are in the top 1% made their fame outside of the OnlyFans platform, like Cardi B, right? The people who have had success on this platform are people who have built a following and simply brought over, their followers to OnlyFans. So OnlyFans is not creating their fame for them. OnlyFans is not creating the business opportunity for them. OnlyFans is only acting as a payment processor, right, for that particular celebrity. I mean, look at this statistics right here. 10% of accounts make 73% of all the money, right? Let me enlarge that a little bit. 70% of all the money is 10%, right? So it wouldn't take a very large migration of content creators to another platform to, to basically, bring the company to its knees. I mean, how much money are they going to make, right? If even 5% of the content creators leave the site, then, I mean, they could lose almost half their income, right? So when you think about, their weaknesses, that's certainly a very serious concern, right? And with regards to threats, right? This is basically the same thing that we're discussing right now, right? Here's another threat that we need to consider. The average earnings for OnlyFans is $180 per month. Okay. Now, what does that mean? Well, if that's truly the case, then that means the vast majority of users, we're talking about not the 10%, but the 90% of people on the have no real loyalty, right? These are people who didn't bring their fame and their followers to the platform. They're trying to create content, attract followers with new content on OnlyFans. And of course, it's very challenging, especially with the pandemic. I saw a New York Times article that said, a lot of women are getting into this because they lost their jobs. They're looking for a source of income, and they're finding out that it's not as easy as they had thought, right? If you're Lady Gaga, obviously, this is a huge opportunity. But like I mentioned, in that case, you don't really need OnlyFans. You already have your fans. You already have your fame, right? You are simply using OnlyFans as a convenient payment processor. So is there a lot of stickiness, a lot of loyalty to the platform? I'm going to say no, And then on the other hand, the 90% of accounts that are barely making any money, $180 per month really isn't that much, especially for posting a lot of explicit content about yourself. And you got to think about this. That content is now out into the internet where nothing disappears, right? You no longer have any control of your own private images, right? And so that's a serious consideration for a lot of people. Are they going to continue with OnlyFans as the economy recovers, right? And so that's another thing to consider with regards to threats and weaknesses is that, as the economy recovers, how many of those 90% of the accounts that are squeaking by are actually going to stick with the platform if they're actually going back to the office, they're going back to their day jobs and making substantial money, right? So those are a lot of serious concerns as a venture capitalist, looking at this valuation. And finally, opportunities. Well, when we go back and talk about the pivot, right? So let's go on to the eventual conclusion that we need to have about this. You know, I think the conclusion that the management has reached is that they are perfectly aware of all the risks and threats to their platform that we just discussed. They probably know better than I do because they're looking at the numbers, they're looking at the internal statistics, and they have determined that we need to move away from this content oriented approach and go mainstream. They need to diversify their sources of income. They need to diversify the type of content that's available to uh, to be accessed on their platform. Which, when you think about it, is a tacit admission of their own vulnerability, right? Because here's the thing, and this is, I think, is the biggest point with regards to OnlyFans and their valuation, right? If their true competitive advantage is the not safe for work images, the content that's available now, right? And they're actually trying to move away from that kind of content. Aren't they moving away from their own competitive advantage? Probably, right? It's unlikely that they're going to be able to, shrink the size of that content to a minor portion of their revenue. I think basically they're stuck with this, right? This is their business model, but they're trying to diversify their income because they also recognize that uh, that advantage could easily be taken away by an aggressive startup, right? So the picture that we're left with here is that the management of OnlyFans themselves are aware that their competitive advantage is likely not sustainable, right? There's certainly an advantage in first mover, and I think their only real advantage is the sheer size. You know, 120 million users is very, very significant. So their sheer size does lend them a certain a weight in the marketplace, and they're able to probably leverage that into reducing their operating costs, right? So taking advantage of economies of scale, whatever internal payment processor that they're using, probably they're getting a very good deal. It's rather in the way that Walmart leveraged its massive sales volume to squeeze suppliers, to maintain their profit margins. But in the end, how sticky is this website in terms of brand loyalty? If a 10% decrease in the revenue share motivated those small numbers of celebrities to move to another platform, they're dead in the water. They are in serious trouble. Their entire business model is at risk, right? And the vast majority of their users, 90%, are not really making a whole lot of money. So, what loyalty do they have to the platform? Probably not. I mean, they are seeing a big surge in revenue because of the fact that so many people were on lockdown and they're home, stuck at home, and watching various online content. But as the economy recovers, a lot of the smaller accounts, the 90%, are probably going to move away. They're certainly going to be less motivated to post content for, $100 per month and giving away private images of themselves. And how loyal are celebrities to this type of platform when they already have their own loyal following, right? They're the ones who are actually bringing value to this platform, not the other way around. So when you look at it through those lenses of valuation, you'll see that theoretically, when you look at the revenue potential, I mean, it's possible that 1 billion valuation is justified, but conceptually, I have a hard time thinking that this company is really worth $1 billion. My conclusion is that the discount factor, the future risk is way too high to justify to say that it's worth $1 billion. I think the sheer size of the company is really what really matters, and I can't say exactly how much because I haven't worked through all the minutia and the mathematics, but a $1 billion valuation seems it's very high, you know. And not only that, I don't think this company can maintain that advantage in the near future because it's the nature of capital free markets that competitors are always going to move into your market, so long as you are sustaining a profitable margin, right? So, as an economist, if I were advising a venture capital firm and they asked me, say, hey, do you think it's worth $1 billion? My answer would be no, right? But again, that really depends on the particulars of the venture capital company and what they're trying to do in terms of managing their own portfolio, managing their own risk, because sometimes they have very safe assets in their portfolio and they want to take a little bit of money and not gamble. They don't gamble, but they're willing to accept a higher risk for higher return. So some of this valuation, of course, would also depend on what's negotiated between the investors in the company and how much of a return is being promised to them, right? So that's my overall thoughts on OnlyFans. I think they're going to have a tough time, getting a valuation of $1 billion, but you never know. I can't predict the future, and it'll be interesting to see what happens. But anyway, so that's it for today. And like I said, tomorrow I'm going to live stream about more recent data about the labor shortage. And then Friday, I'm going to give my assessment about whether Facebook is or is not a monopoly. So tune in for that. If you like this content, go ahead and subscribe. Like I said, I stream regularly Wednesday nights and Sunday afternoons at Pacific Standard Time. And chances are, a lot of times I'm going to be streaming even more, Monday, Tuesdays, Thursdays, and Friday. So there you have it, folks. I hope you found that interesting, right? Giving you a little bit of perspective of how venture capitalists would look at a company like OnlyFans. And yeah, I'll see you in the next stream.